Okay, team, welcome to session two. It's a lecture regarding liquidity zones, gaps, and imbalances. Some really key concepts and tenets here applicable for ICT and many other strategies, and really important stuff to know, liquidity especially, for essentially any strategy, any form of trading. So first and foremost, housekeeping. Nothing in these lectures or coaching constitutes financial advice. All the materials are intended for educational purposes and to enhance your technical ability. The lessons will be recorded and provided for ongoing access. And finally, coaching, it's a self-driven educational partnership. So there's no specific trading results that we're guaranteeing here. There's no outcome. The outcome is education and coaching. And ideally, that partnership helps enhance your ability. Before we get started, I like to have this in all of my lectures, and ideally everyone takes note and pulls the things that they think are most important. But these are some of the most common candlestick patterns. I would say it's not exhaustive, but these are the ones that you don't really need to get too much more complex than this. I would advise everyone in their own time and just in their own sort of way to pick out. You don't need to know all of these. Over time, you will learn most of them if you apply yourself, but you don't need all of them. You just need some. And you look out for the same ones over and over again, and that's how you generate a strategy and develop an edge. And I would advise, or not advise, some of my favorite ones are along this top line here: the hammer, the dragonfly, shooting star, gravestone. Bullish engulfing, bearish engulfing, both very important. The abandoned baby, rare, but something generally useful to know. And the tweezer top are really useful as well. And then 3 stars to the south and the advanced block, really useful. Um, Everyone picks ones that are most applicable for their strategy, and you guys will be no different. So moving straight in, we're going to start with indicators and just reviewing the importance of them. We'll jump to the chart and I'll show you some of the indicators I use as well. So there are a lot of tools out there. You can get indicators for anything, for gaps, fair value gaps, imbalances, Fibonacci levels, anything. And they're very useful, but the key is that they're not magical signals. They're tools. And that means that they're meant to support what you already see in the price action, not replace it. They're not meant to be the thing that you use to understand. They're meant to be an enhancement of your understanding. I generally say that the indicators are not, they are descriptive, not predictive. They show us what has already happened and where potential interest or reaction might occur in the future. But it's up to us to read the context and the behavior. And that's where your edge comes into play. So if you're brand new, I recommend starting by just learning where these indicators typically show up. Where do gaps form? Where do fair value gaps tend to get filled? What does price action do when it interacts with a Fibonacci level? Things like that. And you familiarize yourself. And once you get a feel for that, then you can start to ask the right questions. What is this telling me about buyer-seller aggression? Is this supporting my price read? How does this fit with the overall structure of the move that I am seeing, my internal bias? And the final step is, this is where traders really separate themselves, is how do you turn those observations into a strategy? How do you say, okay, I've seen this setup 100 times, and this is how I'm going to capitalize on it consistently. So for everyone who's learning to be a good trader and a self-sufficient trader, we're not indicator chasers, we're price readers, and we use indicators to confirm, not to decide. And so we're going to jump over very quick into the chart. This is my standard scalping setup. And I use it for a lot of different time frames, but I generally have these indicators. So the VRVP is over here. And this shows me price up, price down. The blue and the yellow indicates buyers and sellers. And you can see that depending on how large the columns are, that's where more participants are sitting at different price levels. The EMA ribbon I use, and you can see it's 5 different ribbons. I have it set for the 200, the 100, the 50, the 21, and the 9. And this indicator gives me a guiding trend line of where price is going and when there's major crossovers that I have to watch out for. It also changes depending on the time frame that I have. Right now we're on the 1 minute, so it's showing me those numbers I just said, 200, 150, 21, and 9. It's showing me in minutes, that many minutes for each one. If I were on day, it would show me that many days for each one, and the line would be smoother or more jagged depending on the time frame. Sometimes I bring up this order block indicator, which we're probably not going to see a lot on the 1 minute, but this would generally show me some order blocks. It's not a replacement for liquidity zones, but it's a good little sort of shortcut. And then sometimes I use this just to give me some indication. We've got a lower high, hammer candle on a higher low. I don't use that too often, but that one is a good learning tool to help you understand what different price reads are giving you. And then down here, I use buying and selling volume. I prefer this view where we have two sides of the coin. So for instance, where my cursor is now, predominantly buyers because it's green, and there was very few sellers with the red. And then you can see over here, predominantly sellers, very few buyers. I prefer this because it gives me an idea of what's actually happening rather than a regular volume indicator just tells you the color when it closes. So it might be green and it might be massive, but it could have been 51%, 49% buyers and sellers, and you wouldn't know. So I prefer this view. RSI, I use the primed RSI chart because it has the signal line, which heats up and cools down depending on direction. I think that's very important to understand velocity. And then MACD down the bottom, a very common indicator that you'll see a lot of traders using, and I have it with the histogram to give me buying and selling pressure as well. Okay, moving to our next slide, liquidity. So probably the most important thing that you can understand, liquidity and volume are the two most important things in the whole market. There's no strategy, there's no successful edge that you can implement if you don't understand those two concepts. And the better that you understand them, the less bells and whistles that you need, the fewer indicators you need, the fewer strategy and the fewer edges you need, because these two things realistically are enough to provide you a winning edge. And then obviously we build off those things. So let's break down liquidity because it's, as I said, one of the most important concepts. And it gets overlooked very often because it's kind of like the plumbing in your house. It's there. Everyone just expects that, okay, well, you know this, move on. But it's truly not looked into enough, or at least by new traders. So at its core, liquidity is about how easily you can get in and out of a position without moving the price against yourself. And what that means, if you sell something and there's very low liquidity, the price is going to go down because there are sellers. If there's high liquidity, there's lots of participants, you selling is not going to impact the price. So you're not going to have any slippage. You're going to get the price that you're looking for. So cash, that is the gold standard of liquidity. It's perfect liquidity. You can use it anywhere, instantly, no slippage. It just is cash. In the markets, liquidity is a spectrum. So some assets are super liquid. Think the S&P, SPY, SPX, or Apple stock, for instance. There's so much volume and such a tight bid to ask spread and tons of participants at all times of trading that you can get filled almost immediately, often without any impact on the price. Now you flip that. If you're in an illiquid market, they're the complete opposite. There's low volume, there's very wide bid to ask spreads, there's not many participants. And the second that you try and buy or sell with any size, even if it's small, price will move. You end up chasing and getting slipped. And that means you don't get ideal or optimum fills. There's slippage. That refers to you losing money just by the act of doing something. Think about, I don't know if you're familiar with this ticker, but Mullen, M-U-L-N, it's not just cheap, it's illiquid. That makes it hard to trade effectively, and especially intraday. So here's the thing. Liquidity isn't just a market characteristic, it's also a risk factor in the context of what we're talking about. If you're in an illiquid market, your risk increases, not just because the price might move, but because your ability to react is reduced. You can't manage your position well if you can't exit quickly. So as a trader, especially if you're scalping or making quick decisions, you need to be in liquid environments. Look for tight spreads, look for consistent volume, look for market depth. That's how you stay in control of your trades.